Hey, welcome to the fourth quarter Strong Valley Roundtable. We've made it through 2022. It's been a quite an interesting year, but just wanted to start off on where the markets are at, and Kyle, you want to do a little market recap for us?
Yeah, I'm going to go ahead and pull up a slide here. There's no way to sugarcoat it. This year's been really a rough year for us. So I know we highlighted a little bit in our last roundtable, but it's been tough for all clients this year, even our more conservative accounts too, because as you can see here from the slide, worst year ever for the bond market. So the U.S. Ag is down roughly 14.5% through September, which was the last quarter. And fourth worst year for stocks, down around 24%. So kind of when you compound that, doesn't really matter if you're a 50-50 portfolio or a 80-20. It's been a tough year for just about everybody. And in fact, kind of when referencing the 60-40 portfolios, that's normally one that we kind of benchmark our clients reference. And the second slide there shows that it's the second worst year ever for a 60-40 mix in the history. And that worst year goes all the way back to 1931. So, hopefully the results will start to turn here, and we'll see kind of like we have historically over the next 12 months and see a pretty good rally on that. And we'll see how that transpires. But yep, definitely a bad year for people to experience with both the bonds and stocks this year. So, and I'll kind of just highlight it with one last slide here. Only the third time in the history of the market that we've had essentially for a full calendar year, both the stocks and bonds down at the same time. And so kind of looking back at 1931, 1969, there's probably not a lot of us here that remember 1931, but 2022 is on pace to kind of be the third time ever. So just no way to sugarcoat it. It's been a rough year this year.
Yeah, so raw data year to date, S&P down 1585. The Ag's down, a little bit over 14. EFA, the international index, is down 1582, and the Nasdaq's down almost 28. Most of your tech stocks. So, like Kyle said, not a great year.
I'm gonna talk for a moment for you guys. I want the folks to see, when we see returns like these, and we see a variance of returns. I've got a chart that'll kind of piggyback some of the stuff you mentioned with what the S&P 500 has done for nearly the last century. And the reason why I bring this up, there's a lot of data on here, but for those listening, the point of this, the point why we mention these returns and mention what some expectations ought to be, so many investors over the years, we've all heard that old adage that if you just kind of leave your money alone, if you leave your investments alone, you leave your balanced account alone, it's not uncommon to average a rate of return of somewhere between 7 and 9%, 7 and 8%, something like that. We've heard that, and that's true. Depending on which rolling 10-year period of time you're looking at, that average holds up. But the difference there between an average and an annual could not be more different. And I think the average investor then assumes that their rate of returns ought to be somewhere between 7 and 8%. And if not, then something must be broken. And they ought to be changing strategy. They ought to be tweaking. They ought to be doing something. And so, when I polled clients to kind of get what they think has happened over the last 100 years, I frame it like this. Of all the sequence of returns that we've seen, and the way the calendar ends up each year, if you had to guess how many times out of the last almost 100 years, the market has finished anywhere between 5 and 10, so you got kind of a 2.5% cushion on each side of the quote, quote, average. How many times out of the last 100 years, plus or minus, has that actually happened? And quite often I'll hear clients say, I don't know, half the time does it bounce around the average. And then maybe a quarter of the time it's higher, a quarter of the time it's lower. That's what the average investor expects to happen. And when I tell them the actual numbers that out of the last, since 1928, only 8 times has the market been finished the year anywhere between 5 and 10. The rest of the time it's way above it, a little bit below it, and sometimes a lot below it. But the variance of returns is pretty dramatic. And so I think that's just wise to take from this as we go through another year like this, especially for the clients, is that when the returns are right at the average, that's actually what's abnormal. 90% of the time, the market ends up finishing something that's quite different than what the average is, and what you end up building.
So sell when we're at the average.
There you go. Something like that. But it's just
no.
I want people to realize that if your annual returns are not exactly what you expect your average to be, it doesn't mean something's broken. That's just the price of admission.
Yeah,
That's
it's a
just how
really
it works.
And you've hinted at that before, Jason, with our financial planning is that, we account for these bad years when we're planning and know that, there's a lot of good years ahead too. And so that's why their average is not exact on in a given year.
That's exactly right. Our software, the financial planning software, and any good financial planning software, and ours is completely accounts and expects for the volatility of returns and the variance of returns. It's just the software doesn't know what the headline's going to be, but we know that it happens so frequently. I was telling a client, in the 20 or so years I've been doing this, the market has been down this much or more half a dozen times. So that's about every 3 years that we have the joy of going through something like this. So it is common, unfortunately.
Yeah, for sure. It's hard for people to get their heads around that the abstract concept. They expect everything to be linear, and even our investors, they know it's not going to be directly linear, but then they expect the variance to be really small, kind of like you're illustrating that. Oh well, if it's if I'm thinking 7.5, then it's probably within 5 and 10, and it just again it doesn't work like that, and that's why investing is it pays to invest obviously over a period of time, but it's difficult because there's a lot of emotion attached to it.
Right.
I think what's a little bit different this time around too is it really is close to a calendar year or the way we measure in calendar years for where this particular sequence happened to. Because oftentimes this will be a July to February thing, and so you get the calendar year numbers that are within reason, but this seems to be early in the year. Now we're 6 weeks out from the end of the year, and it seems like we've had most of the action in this calendar year. So that's why that number I think is going to be a little bit different this year too.
Yeah, you're right. You're right, especially when the way we measure them, right? Because if the top of the market was in whatever September, October of last year, from where you're measuring from point to point, it might be as steep. But the way we look at performance as humans, it always starts on Jan 1.
Yep.
Mm-hmm.
Yeah, unfortunately, economies and markets don't always work on January 1st, but this year we've kind of got it all. So this is another thing to talk about. This has been one of those years where very few asset classes have worked. I want to say it's like 98% of asset classes are down this year, very much like 2008. But one of the things that has worked is the U.S. dollar. Again, not that many people are investing in the U.S. dollar, but just to kind of show historically where the dollar has been relative to other currencies. If we could pop that up here. So there's this, again, this is just an index that tracks the dollar versus a basket of other currencies throughout the world. And you can see the dollar has been appreciating dramatically since basically COVID. Toward the end of COVID there, dollar's been the safe haven asset class. You got other interest rates around the world are lower and then less credit quality than the United States. So you got assets flooding in to the dollar and driving the price up. But recently, dollar has just started to turn around, and you got to think that it can only go so high. There's only so many assets that can flood into the dollar before things start to turn around, and we've seen that in the last couple of months. And just something to mention that the dollar is the strength of the dollar is a big headwind on international investing, because there are two components to international investing. You have the actual asset classes performance, but you also have currency performance. So when the dollar is really strong like this, you're going to see international investments struggle a little bit more than usual, even if their asset performance has been good. But when the dollar weakens, that'll be actually a tailwind to international investing. And we've seen a really long period of time where the U.S. has outperformed international over a decade, and maybe starting to get to the point where that might turn around, and a lot of that because of the strength or lack of strength of the dollar.
And the dollar strength goes along with Fed policy in a lot of ways too. So as our interest rates keep going up, international investors, people that are non-U.S. or banks or institutions, that they're going to want to buy treasury bonds, which means they need to buy dollars to buy treasury bonds. And so part of it is all the geopolitical stuff that's going on around the world. The dollar is still the reserve currency, and that looks to continue for quite some time.
Yeah, you want to? Absolutely. You want to talk a little bit about midterm results? Another thing that's happened in this quarter.
Yeah, let me jump here. I want to show into I found some interesting information. There's this economist and statistician that I follow. Now that we've got the results of what we're seeing here in a more divided government, what I looked at here and what this statistician had pulled is how has this behaved in the past, and it was eerie how similar these results have been. And so what this individual pulled the data on is going back to World War II. We've had 80 years and 20 midterm elections, always beginning right in the first week of November. And what this individual looked for was, how did the market behave 6 months out? Was there any correlation there whatsoever? And what he was able to determine is that if you looked in November, then look 6 months out, give or take around, late June, that so far, and I'm really hoping I'm not jinxing it with bringing this up, but 20 out of 20 times the market was positive 6 months later. And it's difficult to correlate that to something else or just pure coincidence, because you look at over the last 80 years, how many other things have occurred geopolitically, economically, with recessions and wars and Cold Wars and Vietnam. And I mean, everything that's gone over the last 80 years to note that every 6 months following a midterm election, the market was positive. So what he had concluded, and I would tend to agree with, is that typically what happens in a midterm election is you get the party that's out of favor gaining some power back and creating what we all know as gridlock. And what happens during gridlock is you really don't have much happening, at least not in Washington. So no new money's being spent, no new bills, no new surprises, no new tax laws, nothing. Really just the corporations are just allowed to be left alone and go to work. And there's a lot to say for that and how the market behaves 6 months later.
We hinted that, I believe, last time on our last call as well, in the sense that, markets are politically agnostic. We have clients on both sides of the spectrum. But typically, like you said, when there is a divided government, it is more beneficial for the markets for those reasons you just hinted at, Jason. If you're trying to build your business plan for 3 years or 5 years as a company, and you're constantly worrying about new taxes or new regulations or, what that environment's going to look like for you, it makes it hard to plan. And when there's gridlock, a lot less gets done and stay out of the way of business, and business is able to to move forward usually. So I think that's kind of one of the things to look for coming out of the midterm elections is there's likely gridlock now in Washington, and hopefully less spending, which in turn leads to less inflation.
And I think the other way to look at it is, we call it gridlock from a political standpoint. We always talk about politics versus economies and markets. For the market, it's more predictability and stability. Mm-hmm. So they don't consider it gridlock. They consider it more of a known quantity. And I think that's one of the reasons why markets do well after elections, where you have this gridlock, this divided government, because that there's not going to be big changes coming through. Yeah. Let's see, home prices. Another thing that, and this is going to be a big one coming up for sure. You got rising rates, and the U.S. 30-year fixed is now over 7%, and you got that actually equals a 28% year-over-year decline in housing affordability. So the big question is, are we going to see a big housing recession? Which is a big part of people's net worth, a big part of what drives GDP. So it's an important thing. But one of the things that we read is that 90% of current outstanding 30-year fixed mortgages are at an interest rate below 5%. Remember, we've had such a long period of low interest rates that most people who are buyers or had been buyers have refinanced and actually have pretty decent interest rates. And you got adjustable rate mortgages in the minority versus, compare that to a 2006, 2007 environment where lots of adjustable rate mortgages. And so looking at home prices probably declining. I mean, it's hard to imagine that they continue to increase at the pace they've been increasing, but probably not a big housing recession as from, again, what we've read and what we've seen.
We talked about this as it bleeds into inflation also in the calculation of how CPI works, with real estate being such a big factor. I think we're going to get into the waning or at least peaking inflation and where we've been. But with what you're talking about, with mortgage rates going up so much, you're starting to see a lot of reduction in home prices that are for sale, and again, that just indicates a slowdown in prices rising. So whether or not they go fully negative is a different story, but just the slowdown in growth rate is going to be huge for CPI.
I think too with home prices, because I mean this is obviously not a lot of our minds, and I talk to people too that don't even have homes yet, and they're thinking, I'm waiting for this big market crash so I can go out and buy, and where I look at it too, people, the most recent memory we have of a real estate crash is obviously going back to 2008, but I mean this is such an absolute different period where the data I was reading that back in 2007, the average credit quality or the credit score rather of a mortgage holder back in '07 was in the low 600s. I mean, they were really just giving debt out to anybody who wanted it. If you had a heartbeat, you didn't even need a job and you were going to be able to get a mortgage. And now the average credit score of mortgage owners in this country is in the mid to low 700s. And so it's considerably higher quality. Anyone who's gone through the mortgage process over the last few years knows what that feels like. The banks are far more strict on who they are giving money to. So before in '07, you just had massive foreclosures and everything was just crashing in that sense. Now it seems like you're just going to have lower volume. If someone's got a 3% mortgage, they're going to be less apt to move and take on a new mortgage. They're probably going to remodel their existing home. So is that going to crash the real estate market? Probably not. I mean, could it give back a little bit of what it gained over the last 2 years? Sure. But it's a little bit different more. You're having buyers who are just less excited. And that's really the slowdown that we're seeing. And so people are just going to stay in their homes a little bit longer, most likely until rates normalize or come down a little bit.
Yeah, talk a little bit about the car market too. Another area where we've just seen, again, you put a big supply of money into the economy, and used cars. I mean, you got new cars selling over MSRP, and is that starting to turn around a little bit?
Yeah, I think most of us are familiar that when COVID hit and the major auto manufacturers were on a hold, it was really, and everyone had more money too with all these stimulus checks. It was really hard to get a used car, and you heard crazy stories too of someone buying a truck and then selling it 3 months later and making 10 grand on it. I mean, it was obviously an abnormal market. And so now we're starting to see anything that gets way extreme starts to normalize. And then with the rise in rates too, there's a lot of folks out there that have adjustable car loans, car loan rates. And so they're obviously, if they could barely afford their car to begin with, the repossession market right now is running the highest it's been in multi-decades. And so the inventory is building up. I've got a chart that kind of shows what's happening in the car market. I'll pull that up here in a moment. But before that comes up, one thing that I would mention as well, if anyone is attempting to or needs to purchase a car, I would recommend holding off 3 to 4, maybe even up to 6 months if you can. It's going to be quite likely that over the next few months that we see the used car market, which would affect pretty much the entire car market, most likely slow down. I don't know if my chart's able to load, but essentially what the chart is going to show you is the median price of used cars and how it's completely, it went to the moon back in 2021, and now we're seeing it starting to correct. And so that we're seeing that in a lot of the markets, but cars especially.
Well, a lot of that was driven by inventory too. Part of COVID was the supply chain issues and the backup of parts, chips and things that were backed up. We remember back in November last year, all the ships that were kind of stuck in the harbors in Long Beach down in Southern California there. And so I think that as that's starting to kind of back off a little bit, inventory is kind of catching up, and that's going to help, demand with the come down with the higher interest rates. And then obviously as supply builds back up, that should help lower those prices overall too.
Agreed.
Yeah. So
and like every other market, it'll overshoot probably to the downside and then correct back. So yeah, that's probably good guidance to wait on a purchase if you can.
So again, not going to stay right along that average line or within a very small window.
There you go.
Well, I think this ties into a lot of, what our conversation's been this year, and what's driven a lot of the markets is inflation, right? So yeah, I know that we had talked previously about midterms, and that was going to be something that we were watching in our last call, and those are behind us now, but inflation's still here. It hasn't gone away. It might be slowing a little bit. Adam, you want to talk about that a little bit?
Yeah, I mean, that's been the thing on everybody's mind, and all the exit polls for the midterms, that was actually the number one factor, and probably one of the things that swung that gridlock balance of power back. Obviously, there wasn't a presidential election, but you start to see people concerned about inflation and their cost of living, and so they vote accordingly. But we did have a downtick in inflation in October, 7.7%, and probably the bigger issue there is not just a downtick, but it was actually projected at 7.9. So again, people are looking for inflation to start subsiding and coming back toward that, kind of 2% ish historical average. Obviously, we're nowhere near there. We got the trueflation picture as well, which I think inflation is one of those things that it's such a big category and it lumps so many things together that maybe you don't always understand exactly where those costs are coming from. So, Kyle, you want to detail that a little bit?
Yeah, I mean, obviously, as we talk to clients and people, live life, they experience inflation in different areas. I mean, you talk about the cost of gas a lot. You hear that in the news and the price per gallon, but it's the grocery stores. It's your food costs are up, 15% roughly. You look at some of your household durable goods around 15%. Housing, we already talked about that being inflated over the last few years, up 23%, and that might be coming down a little bit here as we just indicated. But it's the cost of just your transportation, your food, and then the goods you need at your house. So those are up a lot higher than that 7% number that we're kind of talking about before, and that's why I think a lot of people are feeling the pain, the impact, paycheck to paycheck with what the cost of living looks like each month. So. Fortunately, like Adam hinted at, we're starting to see these numbers peak and start to come down. And that's kind of one of the things that at least we mentioned last time. And I've used a number of times in meetings with clients recently. Let's see if I can pull up that chart here on, historical inflation and how it peaks. We told clients, market's been rough because of inflation, rising interest rates, and what that's doing to the economy. But eventually that has to peak. And we've been saying for the last month or so that we're starting to get a feel like it's starting to peak. It's not going to go from the 8% number we were seeing down to 5 or 4 in the next month. It's going to gradually go down over time. But historically speaking, once inflation kind of peaks and it's run its course in the economy, we start to see the markets recover. And if we look at historical, peak inflation times, and then we follow it up with 12 months after the peak of inflation, with the exception of 2008. Every stock market period's been positive, and every bond market period's been positive. So, I mean, we'll see what that entails for this situation and the current environment. But a lot of us are feeling that as inflation starts to peak, maybe the Fed will start slowing the amount of rate hikes that they'll do. And you've kind of seen the market react positively the last few weeks with that as being one of the major indicators of that. So, or it's been showing. So,
this is obviously retail inflation, but I did see today where wholesale prices also we're only up 0.2% in October,
versus 0.4.
and versus 0.4. So start to see it in all areas, which is important. So on that inflation note, so what is we talked about? We've talked about this several times before, but just to kind of give you a recap on where we're at. Chris, you want to talk about the Fed funds and some of the adjustments the Fed's made?
Yeah, and we are about a month out from the last meeting of 2022. I think it's December 14th is when they'll announce the next move and whatever it'll be for Fed funds. But we're in the range right now of 3.75 to 4%, which is their the federal funds reserve rate range, and we still think that there's probably going to be a 50 basis point or so raise here at the end of the year, which would put it right to, again, where they've provided guidance before, right around 4.25 to 4.5%. And according to what we sort of gathered from a couple different sources, there's an 80% chance of that being a 50 basis point move at the end of 22. And then, I mean, again, there'll be more guidance that'll come out of that. We'll probably have a fair amount of market volatility around some of those comments, but we would expect the yield curve, so the difference between short-term interest rates and long-term interest rates, we'd expect that to be inverted here going into the end of the year, meaning short-term rates, 1 and 2 year treasuries are actually going to be yielding more than 10 or even 30-year treasuries. So that's pretty, it's pretty rare. It does happen, but these circumstances end up being pretty short-lived, and there'll be some correction, I think, pretty quickly into the spring of 23.
Yeah, just to give you some color on where we were at with again, treasuries being sort of the de facto benchmark. The 10-year started at 175 this year, in 2022, and we got up to a high of 422 in October, and we're about at 380 right now, 3.8%. The 2-year, on the other hand, is a bigger story. Started at 80 basis points. Mm-hmm. So that's your short-term rate. That's your cash rate. Everything drives off these short-term rates. So if you were in cash and money market, you probably weren't making anything at the beginning of the year. 2 years at 80 basis points. It got up to a high of 5.13% on November 2nd. It is down slightly since then with some data we've already discussed coming in, inflation numbers coming down, but it's still at 4.37. So you got, like Chris just mentioned, you got the 2-year at 4.37, you got the 10-year at 3.8 right now, and so you got the 2-year actually yielding more than a 10-year bond.
Well, and I think we've hinted at in the past and recently here that for the first time in a long time, investors with cash or money on the sidelines that have been looking for interest or a safe place to park money that essentially grows a little bit. We're finally starting to see that. I mean, I know a lot of us have been having conversations with clients in cash on the sidelines, and our money market rates are now right around 3.77%. I've had a couple clients recently look into CDs, and you're starting to get paid 4% on short duration CDs. So that is the one benefit. Even our short duration bonds now are starting to, like you said, go up with the yield on those and be paid to hold those a little bit for us. So,
Chris, you want to talk just a little bit about the difference between money market and bank deposit? Just something that, again, this is probably an evergreen topic that people can refer back to. We constantly talk about buying money market, and the first question is it safe? Is it safe? Well, how is it different?
Yeah, and so some of these rules have changed over the last even 15 years. And after 2008, some of those rules changed, but the general bank sweep, whether it's in a at your bank or in a brokerage account, the general bank sweep typically goes into some FDIC insured account that's at some bank that's behind. So in many cases, there's a bank that's owned by the brokerage company, and that's where they sweep the cash balances to. And they pay, right now, a pretty low rate relative to what we would otherwise call money markets. But there is a difference. One of them is FDIC insured and has very strict rules around how you can collect on that if a bank were to ever fail, whether it's if your small community bank is FDIC insured, then it's got the exact same rules and some of the same limits. But money markets are a little bit different. They have rules around what they can invest in. They typically have to be shorter than 1 year instruments that are inside there. But their whole goal as a manager of a money market fund is to provide the best yield for owners of that mutual fund. And so your average in there is often somewhere around average maturity of the bonds that are in there, somewhere typically around 3 months, maybe a little bit shorter. And it provides daily liquidity. In other words, we would have to go in for a client and sell that particular position if we wanted to raise cash out of it, unlike the sweep accounts where you can just write a check against it. So, but it's worth some of the lifting for us to do for clients if we can lock money up and we need and clients can give us 2 or 3 days notice to be able to access that. It's also where we keep strategic cash sometimes for clients. So in investment portfolios, we typically don't want a ton of cash sitting in the sweep account that's giving us
40
less than 0.5%.
Yeah.
When we can get on strategic cash, we can get north right now of 3.5%. So it's not always that way, and sometimes we differ, but certainly right now it's a great place for people that do have cash to be able to park it in a really conservative way and get paid to do that.
Yeah, a couple other points on the money market. So dollar for dollar, so stays at $1 per share. So unlike basically all of your other investments, which have a fluctuating principal value, you put $50,000 into a money market, you get 50,000 shares at $1 per share. So it is more stable. Like clients view cash, but it is still an investment. The other thing about money market is because it's very short-term instruments that they're investing in, the yield will fluctuate based on rates. So they'll always give you an annualized yield that if you held this and nothing changed for 12 months and you reinvested all the dividends, I think today it's at like 3.77%. They call it a 7-day effective yield on one of these money market instruments. But let's say the Fed comes out in a month or two and cuts rates. Well, then right away, the investments in that portfolio are going to yield less. And so the rate on the money market is going to go down. Now, if the Fed raises rates, you'll see yields continue to increase. But it's not a locked in rate like you would get from a CD. It is a constantly evolving rate. But again, this is part of investing and knowing where the market goes. And we just talked about, we expect rates to not only remain, but probably increase from here, at least for, half of next year, maybe even longer. So there's a good chance that, it's not just this rate, but maybe it's even a little bit higher for money market. So for us, again, every situation is different. And that's why we talk to, individual clients about their situation. But, 40 basis points for sweep versus, over 3.5 for money market, that's a pretty compelling risk decision.
Well, you talk about trade-offs all the time. The big difference between the money market and the bank sweep is the guarantee and the backing of the FDIC. So it's there's no free lunch, but this is pretty close. You're not taking on a tremendous amount of risk by moving out of the bank sweep and going to a money market that's giving you, in some cases 10 or 12 or 15 times as much return for just a tiny bit more risk.
And like I mean, I know these are kind of facetious examples, but there is no riskless asset. Even if you had it all in green and it was in your house under your mattress, like, what if somebody steals it? What if your house catches fire? I mean, you got inflation. I mean, there is no true riskless. But if you're talking cash being, the barometer for risk, this is just a very, very, very small step above cash and way far away from being into your typical, bond, stock, type investment. All right. So we're going to kick over. We got the FTX situation going on in cryptocurrency land and obviously bleeding over into clients' questions and the markets. Anybody want to tackle what's going on there? And we're going to try to dumb this down. Again, this is a lot of finance and a lot of things that happen behind the scenes with rules and regulations. But we're going to try to make it as concise as possible so everybody can understand a little bit what's going on with the FTX cryptocurrency exchange.
Now, I'll tell you what, though, I'm excited for the Netflix special that's going to come out on this one. This is going to be nuts. I mean, this can be nuts. There's, for anyone that monitors, Twitter or the crypto market or whatever, this thing is absolutely blowing up. But I would say for our average demographic, our average client, and they might have seen a headline here or there on the news, but this is not specifically related at all to any of their investments. This has nothing to do with the stock market, the bond market, the cash market, the et cetera market. This is purely just into the kind of the wild west of the new exciting crypto blockchain technology. And you've got a nefarious team. Many people that I follow in the community, they're kind of comparing this to an Enron event, where people were taking advantage of a situation and committing fraud. They were using their accounts, and they were a market maker. And basically, think of it like this: they were a market where you could buy and sell cryptocurrencies, and they were using those assets not only to lever and to borrow against client assets, but then they committed the cardinal sin where they actually took some of the client assets to pay off other debts and send it over to other hedge funds and things like that. Long story short, the CEO and founder, Sam Bankman, help me out.
Fried.
Bankman-Fried, yeah.
He's probably figuring out which country of non-extradition he's going to hide out in. But it's going to be headlines for a while.
Yeah, and I think one of the things there, too, with the cryptocurrency and how volatile it is, everybody's seen the volatility. So one of the things was they were using their own token as collateral. So you're using your own token as collateral that then he's loaning funds to a hedge fund that he also owns. So there's a lot of self-dealing and commingling here. Again, I think everyone understands that crypto is pretty new, pretty infant asset class, and it's highly unregulated. And these kind of situations will bring more regulation in the future, but it's why just jumping into something, both feet, and this is going to replace all my stock bond investments because crypto is the future. It may be the future, but it's not the present. It's going to take some time to develop.
Well, and I think this is a learning lesson for people too. I mean, so many investors out there, we get jaded by what we see on social media, and everyone's looking for the get rich. And they heard about one person that made a fortune by investing in this one-off cryptocurrency that doubled overnight, and oh gosh, that could be me too. But these events, anytime you've got a new asset class forming, and we haven't seen this happen in our lives, but it's going to be a wild west until it gets figured out. And I could see one silver lining coming out of this would be a little bit of regulation. There are probably corporations and businesses and other high net worth individuals that probably can see opportunities here, but don't want to put a business risk into what I've been referring to as kind of like the Wild West. They want to see a little bit of guidance, a little bit of reform. And you have someone like this that pulled off kind of like a Madoff event where stole client assets. It will most likely create a little bit of regulation, and that may not be a bad thing.
For sure. There's actually a great clip with Warren Buffett and Charlie Munger. And listen, I get they're old and a little bit old fuddy-duddies, right? But they're super smart and they've made a ton of money. And them talking about cryptocurrency is just classic because, but they do hit the nail on the head. I mean, it's an infinite asset class. You get all these people in. We've seen many things that I've watched a ton of stuff on cryptocurrency, and the experts that I've listened to believe that 90% of these coins are going to end up worthless. Right. You got all these coins in the market, and Dogecoin, and they're based on nothing. They don't. And again, what Buffett said was, it doesn't produce anything. It's purely speculative. You're buying it because someone else wants it. That's the only value there. So, like I said, this market will shake out. But I think the question that everybody wants to know, at least it would be listening to this, and I'll let you tackle this, Chris. Can this happen to my assets at Schwab? Same thing that happened to FTX.
Well, and so the lesson's the same. I looked it up the other day. So it's been about right at 14 years since the Bernie Madoff thing, right? That was late in 08, December-ish of 2008. And the same lesson is there. There's a big difference between an institution that takes your money and uses it sort of in whatever fashion they want, and a custodial relationship. And so this question's even come up this week. Is my money safe? And our practice is to use well-known large custodians, basically just to hold assets for our clients. So those are not on deposit at Strong Valley. Those are held at large custodians, whether it's Schwab or Fidelity or you name the big institution. And we did that on purpose when we started this firm, and everybody that's joined is on the same page. We want client assets to have market risk, right? There's market risk, but we don't want them. We don't want clients worrying about where the money's being held, and that's why we're most interested in using large institutions for custody only, and not for lending things out. So.
Yeah, I remember
it's a difference.
I was going to say, I remember starting Strong Valley up and telling clients, you're not going to write checks to Chris and Adam. You're going to have a place like Schwab, Fidelity, that's going to hold your money, and that's going to keep it. Again, they're custodian. That's going to keep it safe. And if anything happens, they have deep pockets, and you can go after them. But again, the risk there is relatively, I should say, extremely low. It's not at all like the FTX situation, but again, when you only have a little bit of information, it seems like that that could happen with your assets.
Well, aside from just a big name that's recognized too, like Schwab or Fidelity, it's also the regulation. We just talked about how unregulated the entire crypto space is, and that for a lot of people was the appeal to crypto, was the lack of regulation, lack of government oversight. But
FTX was also headquartered in the Bahamas. It's a
And
little bit different
for a reason.
in comparing to Schwab. Schwab being absolutely regulated by.
Bahamas, Seychelles, Cayman Islands. Yeah.
A little bit.
There's a reason for that.
But
So you want to talk?
So the Securities and Exchange Commission really oversees these custodians. And there's, I'm not going to talk about insurance, but whether it's SIPC or any of those, but it really is for soundness of the custodian. And we've seen situations, again, going back to financial crisis where large, the Lehman as an example failed, right? And so people that were invested in Lehman as opposed to invested at Lehman were handled very differently. If you owned Lehman shares, bonds, et cetera, you were invested in that company versus if you were part of a private client group there that had custody there. I believe Fidelity got all of the Lehman private client stuff, and so you had a new account established at Fidelity within a very short period of time, and you got a notice that your shares of General Electric or Amazon or whatever were just held at a different custodian. So you still had all the shares and all the rest of that, but they were just set up in a new custodian. So there's an orderly way that custodians failing is handled, and that's a really, really good thing for our folks.
And that kind of goes back to the whole, we always have this discussion with clients about being invested in the bank. You put money in bank deposit, which we just talked about. I mean, you're invested in the bank. You give the money to the bank, they turn around, loan it back out in the forms of loans, and that's how they make money. That's why FDIC insurance exists, because the government is protecting your money in case the bank goes under. I mean, there was a time where that didn't exist, and we saw big issues. So that's why, and that's why the question always comes up about FDIC insurance, and then inevitably people don't understand the difference, and they'll have the same question about a Charles Schwab or a Fidelity, a custodial relationship. Was there FDIC insurance? Well, no, because you're not depositing your money into Schwab and allowing them to loan the money back out. It's a custodial relationship. So two different types of relationships. Chris just explained the custodial relationship, and it's quite different.
What are some other things that have been kind of coming up from questions from clients right now? I know we've been having quite a few meetings lately. Whenever things get a little bit choppy or bumpy here in the markets, clients are obviously more willing to meet. And I know that the four of us have been pretty busy lately. What are some of the conversations you guys are having? I think Jason was mentioning something the other day.
I think we're all talking about the big R word.
Yeah.
Right? Okay, so obviously that's on everyone's brain. Everyone is expecting a recession next year. I think the conversation is more about the depth, the length, everything like that. But I've got some data I'll pull up, and when I think about this too, and not that I'm specifically trying to be a contrarian, but I'm trying to think of the times in history. In the 20 years I've been doing this, and anyone older that's been doing this longer, I don't know if I can come up with one time in history when every analyst, every expert, every investor all expected the exact same thing to occur, and they were all right. I mean, and we're all in the same boat right now. We all expect a lot of pain next year based upon what happened with interest rates and what might happen as far as a recession to occur. And not that I'm saying that there won't be a recession, but the debate is out as far as how that may affect our investments and how that may affect the market. So what I've got here, and I'll explain the data in just a moment for those that are watching. But for those just listening, I'm kind of explaining how a market has led up to recessions in the past, now looking back at that. And I kind of described it to a client, think of yourself like last time you were in traffic on a freeway, but not just like rush hour traffic. You're just driving normal stage of traffic, middle of the day. And then all of a sudden you see all these cars start backing up, slamming on their brakes, red light, red light, red light, red light. And now your car's not moving. You're at a standstill. Something's probably telling you in the back of their mind, there's something going on a mile up the road, most likely an accident. What most people do after they've been sitting in their car, has not been moving for a while, the first thing that they're going to do is pull out their phone and start trying to figure out a way to detour it. Pull out Waze, pull out their apps, get out maps. How are we getting around this? What exit are we going to take? Should we turn around? That's what most of us do when we're driving. And we do the exact same thing with our investments as well. And the patterns of our behavior around businesses and hiring employees and things like that. If the average American is expecting a recession next year, they've already taken precaution, if they plan on taking any precaution whatsoever. If you own a big business and you're thinking about expansion, you're probably telling yourself to hold off a little bit. Maybe I'll only hire what I absolutely need and not do a giant expansion into next year. If there are clients that are absolutely nervous about next year nationwide, most likely they've adjusted more into dividend paying stocks, or maybe they've added a little bit more cash reserve, et cetera, et cetera. So most people will affect their behavior on the rumor before the news. And so what you're seeing here in this chart, You've got every recession that we've gone through in this country since World War II. And then you see what the stock market has done before, during, and after those recessions. And so for anyone that can see this, the main point of this is the third column from the left, titled Before. And what it shows you there is 6 months. The majority of the pain in the stock markets occurred 6 months before we ever even knew we were in a recession. So by the time we actually figure out, oh yeah, GDP tells us we were in a recession last quarter, more often than not, the bottom of the market was in the rearview mirror. And so I think this is a very, very good piece of information. Whenever I have clients that ask, hey, if we're also sure that there's going to be a recession next year, shouldn't we get out now and wait for it to happen and then get back in? And then I think that's a very dangerous move to make, because of the data shows you here, by the time you figure out that, yeah, we were in a recession, you probably completely missed the bottom.
And this goes back to that markets are leading indicators.
Yep.
Right.
And not just a month, but 6 months to a year. I mean, the market is already priced in that they believe that we will enter a recession. It's just a matter of when and how bad that recession is. Obviously, if there's, more and more negative news coming out, then the market will probably react accordingly. But you can see with just slightly positive news how positively it reacts. Not because that, again, going from 7.9 to 7.7 inflation is not a home run. That is not a good thing, but it's better than it's already priced in. So
I used to tell people, Adam, I used to tell people all the time that the news doesn't need to be good for the market to go up. It just needs to be less worse.
Yes.
I mean, because
less bad than expected, right? Less bad than expected.
If we've already priced in misery, then all that has to be is just a little less bad, and buyers will come back in. I remember going back to the old COVID days, the bottom of the stock market. The bottom of the stock market actually occurred before the first U.S. death was reported, which is nuts, right? So we think about how bad 2020 was,
Yep.
All of the pain, the sickness, the death, et cetera. The bottom of the market was actually before any of that had come in, because we had priced in, end of the world. And then once that didn't occur, and it was really bad, but not end of the world, the market recovered.
Yeah.
Well, that goes back to something you've said a number of times too, Adam, is, you have to be right twice, right? So
For sure.
Those that are trying to time the market and get out, well, one, we just talked about it's the worst year ever for bonds and fourth worst ever for stocks. We've already experienced quite a bit of pain. And so now, being that the market's a leading indicator, it's already sold off. So you're not really getting out of the way of it. You've already experienced it. And then for those that react on emotion, if fear or panic drives you to sell, the only thing that's going to motivate you to buy back in is things are better. And so it's that whole, it's hard to win if you sell low and buy high. And so,
yeah. And everyone's seen the chart. We don't have it here, but everyone's seen the chart of if you missed the 10 worst days or the 20 worst trading days or 50. We just had one of those the other day. Not that, again, we're at the bottom of the market, and bottoms are, very difficult to predict. And that kind of get into our next thing. But when the inflation report came in 2% under the expected number, the market was up. 0.2. Yeah, let's be more specific here. 0.2. The market was up 5%. So if you missed that day, that's a 5% move that you missed. Again, is that gonna, in the long run, is that gonna kill you? But if you miss the next 6 months because you're waiting for something bad to happen and the market rallies 20% or 25%, then you've ridden it all the way down, got out, and then missed all the way back. And this, can't overstate how often this happens. Not to our clients, thankfully, but the average investor does this all the time. There are numerous studies on the average investor and how poorly they perform relative to just buying some kind of index, which, again, I'm not advocating is the greatest strategy, but buying some kind of S&P 500 index and just holding it and doing nothing. Because they always act on emotion. They always think they're timing something, and they don't even know what they're timing, just as Jason was just talking about with the recession.
The question is, how much higher do you want the market to be before you get in?
Right.
And that's
always the case.
There you go. And you're admitting that you want the market to be a lot higher. That's probably not good for your performance numbers.
I think another segue there, another common question, and this goes into trying to time the markets. A common question that I'll get to is, I've been kind of parked on the sideline with some cash. I've had this over here at the bank. I know rates are better here. Is this really a good time to be buying? What are bonds doing? Should I enter that market now? And I'll let you guys offer your opinion. But I was going to mention, when it comes to the bond market as well, because I've had clients say, well, shouldn't we wait till after the government raises their rates? we've spent a lot of time talking about how markets are leading indicators, and the bond market is the same. Jerome Powell over at the Fed, he's done exactly what he said he's going to do so far every single time this year with no stray. And he's laid out, we're all expecting a 50 basis point hike at the end of this year and 25 basis point to start the new year. That has already been baked into the cake. So what would cause rates to go up more than that is obviously a change in news, change in inflation, or his speak would be different. And so it's unlikely, if he does exactly what he said he's going to do, it's unlikely that rates should go that much higher from where we see right now, at least on the longer end of the curve. And so I've been telling folks, if you're sitting in cash, bonds are starting to look more attractive right now. The rates are much higher than they were a year ago.
So Jason, why are bonds starting to look more attractive? Just so everyone understands.
Thank you. Yeah. So what has happened here, like the very first slide, I think Kyle showed the worst bond market in the year prior to this year. I think the bond market dropped 4% to start this year. Kyle, what did your slide say to start the year? Down 16.
14. Well, it's been as high as 16, but through there it was 14.9, I believe, on that one. But it's been as low as 16 on the ag.
And I think the ag is down 14 right now.
So the sell-off that we've seen this year in the bond market is about 4 times worse than the previous worst. And so you want to talk about buying low. The bond market, for a little more explanation for folks, the reason why the bond funds that they own are down is not because of the quality of the stuff inside. You know, in many of the cases in a lot of the bonds that we own, they're investment grade, or what we would call top tier types of bonds or debts inside that you know, from the federal government or from AAA rated companies like Microsoft and Johnson & Johnson and Apple Computer. None of these outfits have had any trouble making their bond payments. The reason why this has come down so much is because the newer, shinier rate is that much higher, because the rates have come up so dramatically on the outside that if someone were buying a brand new bond that would pay more, it's more attractive to them. So the older stuff has to come down in price to kind of equalize out. And so now what we're looking at with these yields on a lot of these bond funds, an investment grade bond fund a year ago was paying less than 2%, and now it's paying over 4%. And this is the same bonds. And so now those yields, those dividends that are coming out of these funds are beginning to look quite attractive for longer term money, just to kind of let it reoccur and park and earn interest. The other thing, go ahead.
I was going to say, and if you think that rates are, you know, kind of topped out, we talked about maybe another 50 basis point hike in 25, maybe in 23, but eventually rates probably will go back down. Again, just looking at historical, how things have worked, if we go into a recession, they'll need to probably cut rates. And if you cut rates, then your bonds that have the higher coupon rate actually look more attractive than the new bonds. And that actually increases bond prices. So,
well, that slide highlighted that too, Adam. If you look at the 12, that same slide, that, you know, down 14.6, if you look at the next 12 months following that, you know, for the most part, we've had pretty positive returns in the bond market. And it's because usually it's the raising the interest rates that kind of sets that bottom floor of the performance for the bonds. And then eventually they do have to start cutting rates. They don't ever keep them up as high as they were. So
last point I'll mention on cash, if I'm going to try to pull up that slide that I had on recessions that showed the 6 months before, because the point that I'll make there is, if we had Warren Buffett on this call with us right now, he wouldn't be able to tell us what's going to happen over the next 6 months. We don't know. No one knows that short of a time window. But if you start looking here 1 year, 3 years, 5 years, 10 years out, very few of our clients need all their money back in the next 12 months. Even if they're retired, they're going to need a little bit of money, but they're not going to need it all. And so if I'm sitting on a big pot of cash, you know, I've got money at the bank, I'm just kind of nervous about what's going on. What I've been advising people to do is just to begin dollar cost averaging. We don't know if the bottom of the market is behind us in October, or if it's going to be ahead of us, but it's likely to be close to us. And so I would begin dollar cost averaging and just kind of getting that cash to work, because every indicator we've got, whether it's in bonds or stocks, once we look out 12 to 24 months, when you've hit these big, massive lows, very rarely is the market still down.
What about people contributing to corporate retirement plans, 401ks and things like that? Where does your guidance go there?
That's a good point too. Well, let me back up. You've got some people that are holding off on adding to their retirement account because they're nervous. I would definitely advise them against that. But then another thing to consider starting into the new year, because now we're finishing up the year, they're most likely maxing out their plans if they can. But then as you start into January, one tactic that one could take upon themselves, rather than if they add money to their 401k every single month throughout the year. If they can afford it, one strategy might even be front loading it and piling in their savings for 2023 all into the first quarter. That could be a way to take advantage of the correction in the market.
For sure. Yeah, I think to the cash question, I mean, the answer always is how much time do you have, right? And you kind of alluded to that with Warren Buffett. Like, if somebody says it's a good time to invest cash, the first question is, well, how much time do you have? 6 months? I don't know. I don't know if it's a good time to invest cash. I mean, I wouldn't take too much risk because we don't know. But like your chart showed, if you're talking,
when you say, hold on, when you say invest cash, you mean put it into equities and longer term
correct
bonds.
Yeah,
Okay.
Sorry, I didn't mean invest in money market. Invest cash into a diversified portfolio with some risk to it. But again, as you look over time, I pretty much tell people it's always a good time to invest cash if you have the right time horizon. Mm-hmm. If you have the proper time horizon, which for us, we pretty much tell everybody, if you don't have 5 to 7 years, you probably should be reconsidering investing in a true diversified, portfolio with some real risk in it, with some equities. If you're talking about
bond portfolio,
yeah, stock and bond portfolio. If you're talking about, hey, I want to shift my bank deposit to money market, well, then yeah, you don't need 5 to 7 years for that. But your average, your typical Strong Valley client that's looking for real investment return over a long period of time, and wants an advisor to spend 15, 20 years with them. Again, you're nickel and diming with which day to get in, because one of the things I've heard recently I think is great is about market bottoms, and it's so true. I mean, everybody's waiting for the market bottom, but when we'll know when the market bottom is? About 6 months after the market bottom. Mm-hmm. That's when we'll know. You go, hey, that was the bottom. And if we had a time machine, it would be awesome. But we don't have a time machine, so you kind of just got to go with
still no time machines.
No time machines, unfortunately. But that's true, though, right? Everybody always wants to look back in hindsight and go, "Oh, this was the bottom." But at the time, you just don't know, and you can't predict it.
Yep, agreed.
Other cash thoughts? Good time for cash. Good time for bonds.
I think we've hit it on it. I think it depends, one, like you said, timeline, but two, we're seeing higher interest rate on the short-term stuff now. So money that's sitting there that you don't need today, if you're willing to take a little bit of risk on it, even our short-term corporate bonds are even paying us, pretty good interest rates now that we weren't seeing 6 months ago. So it's definitely worth looking into depending on your situation.
Okay, let's talk a little bit. We always kind of do a little recap, because I think it's, again, this is my thing. I think it's important to kind of realize what you said and where you're at now. Last one was in mid-August, and now we're in mid-November. So last roundtable, we talked about inflation. May not be down as far as we want by year end. At first we were hoping, again, beginning of the year, hoping to be in the 4 or 5% range. Doesn't look like that. But I think last time we said that maybe mid 2023 before we hit 4 to 5% range, and that's not looking too bad at the moment. Again, you're starting to see that decline. I've seen quite a few predictions out there that maybe 3-ish%. Again, these are very fluid and very dependent, but maybe 3-ish% by June or July of 23. So that's not too bad. And then the other thing we talked about. Oh, good, Kyle.
I was gonna say, like you said before, as far as if we're going to call our shots or make our predictions, we have to own them on both sides. So I think those.
No, we're not going back to them.
No. But I would say though that if we were doing this, a couple weeks back, we wouldn't have enough data in front of us. But one of the things we did talk about is that we've been looking for is a slowing down in inflation, and that would be a potential boost to the markets. And I don't want to get in front of it or get too excited about it, but the most recent data is showing that that's at least happening. Like you said, very minimal, but it's slowing. And the last few weeks, we've had a pretty good rally in the markets with it. So we'll see if that trend continues. But that was something that we did talk about last roundtable, and I know we've mentioned a lot with clients lately.
Yep. Yeah, and I think one of the things we talked about also is that rate hikes were going to be slowing down. We thought maybe we might get the last one in September, but never really sure. And then I think shortly after that, he came out and said, no, we're not slowing everything down. We're going to keep it. Again, it's all dependent on people's opinions, so you don't really know what they're thinking until they come out and say it. But I think it's pretty concrete now. Like I said, we're at about an 80% chance for 50 basis points. And again, how we determine that? How do we determine 80% chance? Well, there's a futures market. Again, I won't get into the weeds on this, but there's a futures market that basically you can tell where people expect, where investors, traders expect the Fed funds rate to go, the interest rates to go. And it's about 80% that there'll be a 50 basis point hike in December, and then I'm going to say it's about 44%, 45% that will get another 25 in February. So again, starting to see a slow, no more 75s likely. Again, could change at any time, but that's what we're seeing right now. And then eventually kind of reach that terminal rate that we probably don't go above at this point, where what it's looking like, and then eventually as a recession will hit, and we talked about this before, the recession will hit. Folks, it will. We're absolutely guaranteed to go into recession at some point. It's part of a market cycle. We're not going, it's like a circle. You have to close it. We have to eventually go into recession and to get through a market cycle. So again, hopefully it's a little ways off, but that'll probably be 23 or 24.
And the Fed won't necessarily say it this way, but I feel like they really need to see a fair amount of pain in the labor markets. We started to see a lot of layoffs or announced layoffs, slow down in replacing workers. They're gonna want to see a lot of those indicators come in, indicating that there's real correction there before they're gonna take their foot off of it. And I mean, like you mentioned, it's an unfortunate part of the circle, but it is part of the circle, and that's what gets inflation numbers to come down, when people are not willing to just pay the next highest price for whatever that good or service is, and they stop, and they slow down their spending streak. So, I think that's probably a pretty safe assumption too.
So, any predictions going forward?
I got one.
Yes.
I predict we will stay invested. That's going to be an easy one to fix.
That's an easy one. I will say I did hear one, and I'm not 100. Again, you're never 100% sure, right? But it did seem plausible. We just went to a conference and listened to some good speakers, and states of the economy and markets. And the Fed was really late on raising rates in this cycle. And if you've looked at any, we actually talked about it, I think, in our last monthly Market Matters, the slope of the rise in rates has been way more dramatic than the past. I think it's 5 rate hike cycles. So typically it's more of a flatter, longer drawn out period. I mean, if you see 50 basis points, that's like a big deal. And we're just throwing out 75s, right and left. So it's been a very dramatic increase in rates, and I think that's because they were late on getting this started. And one of the things that I heard from Jeff Gunleck actually at Double Line was he thinks, hey, they were late to the party, and then they basically have overdid it, and we're probably going to see inflation not only come down, but maybe get into a deflationary environment for a short period of time. That's definitely not something that we want to be in for many reasons for a long period of time. But again, when you have this type of, this rate hike it's not like you hike rates and you see it next week. It's something that takes time to develop, and this is a very aggressive rate hiking cycle. So we may actually be in for a brief deflationary period, which would mean they'd have to cut rates a little bit sooner. So may again see that rate cut sooner rather than later, but it's something to watch for next year for sure.
Gunlock's pretty boisterous too, so
he is.
He's not afraid to shoot from the hip.
No, he is, but he's fun to listen to because again, you get a lot of what would you call it, business speak or politically correct speak in what we do, because nobody wants, everybody wants to talk, but nobody wants to be wrong, and it's fun to listen to people that actually have opinions. And will stand by their opinions. Like I said, like we were talking about with these predictions, like everybody can get on Twitter or their whatever social media and throw predictions against the wall and just let them fade off into the sunset until one hits. But actually being able to stand behind what you say is, those are the people that I try to follow.
Yep.
So everybody's in agreement. So deflation, that's what we're going for.
Well, unfortunately, I mean, I think that the one thing I know the Fed doesn't want to do is do all this pain, all this rate hikes just to have it for naught. And so I would imagine if they're going to take the risk of being wrong, they're going to take the risk of being wrong to the upside as far as interest rates. And so it wouldn't surprise me if the 50 and 25 is not the end of it. If the inflation seems to be a little bit stickier, which is possible.
Yep.
Because the things that are driving inflation as well, we see that in wages, in labor, and in housing. And you know, there's a lot of things that are coming down quick, but especially labor. I mean, that's rather sticky. Rent can be rather sticky. So it wouldn't surprise me if interest rates stay up. If they raise rates, maybe even a couple more times, it wouldn't surprise me. Depending upon how Jerome Powell kind of discusses what he's doing and why, the market will react accordingly. It probably won't love the fact that rates are going up more. But as far as a prediction, I'll back to my last slide. I'd be willing to bet that the bottom of the market, if we haven't seen it already, it'll occur prior to us realizing that we're in a recession. Assuming we'll be in a recession in 23, who knows when, or maybe even fall into 24, I'll make the bet that the bottom of the market will be before the government actually announces negative GDP double quarters, or however we define it now.
And then we got the whole argument of what is a recession. We're not going to go there. We're not going to go there.
Don't start.
Start the second hour.
Well, good. Hey, thanks
right.
everybody for joining us. Really appreciate it. You know, like always, if every situation is unique. It's fun for us and hopefully fun for you to hear some of the questions that we're getting and a little, you know, a little more of a more detailed breakdown on the markets. But reach out to us. We love to hear from you. You know, we like doing what we do. We like planning for people. So, and like I said, every situation is unique, and we're glad to talk to you. Glad you joined us today. Yeah, go ahead, Chris.
Yeah, real quick. So I think this is the last roundtable of the year for 22.
Yeah.
So we want to make sure we wish everybody great holiday season too.
Absolutely. Yeah. And one of the biggest things too is if you have topics, if you have things that you want, these have become really popular. We got a lot of people listening to them. It's great. If you have things you want to hear, this is for our people. Like I said, we enjoy doing it, but we want to talk about things that are interesting to clients. And so hopefully we're doing that. But if you have suggestions, we're happy to hear them. Good time, guys.
Absolutely.
Absolutely.
All right. Thanks
Thank
everybody.
you all for tuning in.
Yep.
We'll
Have
see
a
you in
good one.
23. Thanks.
See ya.